Welcome to Nasdaq Trade Talks. I'm your host, Jill Malandrino, global markets reporter at Nasdaq. Joining us at the market site in Times Square, we have Jeff Schulze. He's an investment strategist over at ClearBridge Investments. We're going to be taking a look at where to be bullish in 2020 if we all had that crystal ball. It's great to have you back with us. Happy New Year. Valuation and allocation trends. It's interesting. As good as it was in 2019, you think it could still be positive for equities in 2020?
I do. If you look at the last 11 economic cycles, going back to the 1940s, typically at the market peak, the valuation of the trailing market multiple has traded at a premium versus its 5-year average of 27%. The market to peak, which we'll say is 1231, is trading at a slight premium of 6%. So valuations certainly could expand from here. One of the reasons why we think valuations could expand from here is investor flows. Now, 2019 was a banner year for the markets, but investors really didn't participate in it. If you look at bond and money market inflows, it was around $870 billion. You saw outflows of global equities of $215 billion, and the net difference between the two was $1.1 trillion, which was the largest differential in financial market history. So you could have a little bit of investor FOMO here, where investors pile back into equities and cause multiples to reach a little bit higher from here.
All right, it's interesting, in 2019, there was a talk of recession and the inverted yield curve, and that never came out to play out to anything. So upcoming quarters, you're going to be looking to see how is that going to determine what the fate of the economic cycle looks like. And of course, you have the proprietary recession risk dashboard. Do the risk parameters look the same as it did in 2019, or are you seeing anything different going into 2020?
They look the same. We're still solidly with a yellow overall dashboard signal, which means rising recession risk. It doesn't mean that a recession is a foregone conclusion. But when you've had a yellow dashboard signal, typically it's taken about 6 or 9 months for the data to reaccelerate and the overall dashboard go back to green, which is expansion, or decelerate and goes to a recessionary red. And it turned yellow in July of 2019. Fast forward 6 to 9 months, that means that the first quarter of 2020 is going to be pivotal, I think, for this economic cycle. And it really rhymes with what the market is saying. If you look at all the last times that we've had 3 rate cuts and the Fed did 3 rate cuts, traditionally in that 3 to 6 month period, if the markets were positive, post the rate cut, you had a soft landing like 96 and 98. If the markets were negative, you had a recession like 2001 and 2007.
All right, and you're looking at more than just the yield curve. There's 12 parameters that you're looking at within the recession risk board, right?
Correct.
All right, so what are some of the others that are giving you clues into that?
Well, the one that we're watching really closely right now is jobless claims. Traditionally, jobless claims are the last one to turn red. It turns red about 3 months prior to each recession. And when you see jobless claims increase year over year by 12%, it's always been recessionary. The good news is that even though we had a big jump in jobless claims in the middle of December to 250,000 jobs per week, that's come back down to the lower end of that band at 210,000. So layoffs aren't here, which means the economy can continue to move forward in the near term.
All right, now speaking of the secular bull market, are we halfway through? Do we have a little bit more room to go there?
Yeah, so if you look at the last 90 years, the market goes in longer term periods, 10 to 20 year periods where the market goes nowhere, and they're always followed by a 20-year period where the market has outsized equity returns. It's our view that the 2010s was the last secular bear, and we're now 10 years into this secular bull market.
So we should have till 2020 of more bullish action, is what it's suggesting?
Another 10 years of bullish action. We think we're going to see a lot more all-time highs, but maybe most importantly, if you look at the average drawdown that you see in a secular bull market, it's only 25%. So if we have a recession, we don't think it's going to be the 08 or 01 experience. We think it's going to be much more tame.
All right, Jeff, thanks so much for joining us at MarketSite. And thank you for joining me on Trade Talks. I'm Jill Malandrino, global markets reporter at Nasdaq.